Hey everyone, Disney reported quarterly financial results that were mixed. It had some good news and some bad news for Disney stock investors. More importantly, and perhaps more broadly, Disney's results had news for the broader market, what consumers are spending more money on more recently compared to what they were spending more money on a few months ago. I'll talk about the macroeconomic impact coming out of Disney's results as well. Additionally, I'll update my buy recommendation for Disney stock in this video. Coming into this quarter, I had Disney rated as one of my top stocks to buy here in 2024. I'll update that recommendation and let you know if I still think it's a top stock to buy. But first, I'll review the latest financial results and the broader market implications of Disney's results.
I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.
Alright, so I highlighted at the beginning of the video that Disney's results were a bit of a mixed bag here in 2024, in their third quarter of 2024. And I'll start with the downside, and that was that in the third quarter, Q3, Experiences revenue increased by only 2%, and segment operating income decreased by 3%. So Experiences revenue, this is the segment that houses Disney's parks segment, the theme parks. And this segment had been absolutely thriving since economic reopening gained momentum. People were unleashing pent-up demand to get out of the house, and theme parks were one thing that people were not able to do during the pandemic era lockdowns. So this segment absolutely thrived. And now I'm seeing the ceiling here. And this corroborates several other data points I've seen from other companies and other macroeconomic data where consumers are now exhausted of going out of their house and seeing the prices they have to pay when they go out of their house. Every time you step out of your house, the price seems to be increasing by an increasing rate. Disney's theme parks specifically have roughly doubled in price since before the outbreak, 2019. Now, I live in the Los Angeles area, and I used to frequent Disney's theme parks, and I've stopped going as often, and I don't think we've gone in more than a year now because of these price increases. Prior to the outbreak, a family of 4 could visit Disney's theme parks here in Los Angeles for roughly $500 for a trip for a family of 4, including parking, tickets, and food. Now, that same visit with the family of 4 will cost you roughly $1,000 with the tickets, the parking, everything included. So prices have roughly doubled from where they were in 2019. Disney has been able to do that because people kept going and going and going despite all their price increases because of that pent-up demand to get out of the house. And so Disney had just been saying, all right, you keep paying, we'll keep raising prices. You keep paying, we'll keep raising prices. And so they've just tested consumers over and over again, and consumers just kept paying. And it looks like they hit the wall here. It looks like that was the end of that benefit of that away from home trend. And it looks like things are turning around. Now, this follows what I've seen coming out of a company like Airbnb, which also reported diminishing demand as a result of people being exhausted of going out of their house and paying all of these high prices. I've seen similar results from several restaurant companies. I've seen similar results across the board where the consumer is now shifting back to a more normalized spending pattern. A normalized shift between services, meaning away from home, and goods, meaning staying at home or consuming at home. And so this has broader market implications, and this is good news for companies like Amazon and PayPal and Netflix and others that benefit when consumers are spending more time at home. And Disney specifically, one of Disney's segments specifically benefited as people were spending more time at home. Disney's entertainment and direct-to-consumer segment was better than expected in the third quarter, and combined with the profitable results at ESPN Plus, that segment reached profitability for the first time in the company's history. Disney had forecasted this segment was going to be profitable in the fourth quarter, And so they achieved profitability 1 quarter ahead of expectations. And again, that's a result of the changing consumer behavior. People were spending more time at home. And if they're spending more time at home, one of the greatest values is a streaming subscription. For less than $15 a month, you can get Disney Plus, which can entertain your family all month long. And so it's a good value for price arrangement, and Disney saw that in consumer response. Consumers chose that over some other choices they may have had. So that's what I mentioned in the beginning of the video when I said this quarter was a bit of a mixed bag for Disney. The theme park segment did worse than expected, and the streaming segment did better than expected. So they had a bit of a mixed quarter. Now, management did highlight that the theme park segment will remain under pressure for the next couple of quarters because they have visibility into forward demand. They can see what people are reserving ahead a couple of months and a couple of quarters, and they're seeing this slowdown ahead a couple of quarters. Now, the good news for Disney is they have options. They have flexibility in what they can do to increase consumer demand for its theme parks. They do this thing around the Los Angeles area where they offer 3-day tickets at lower prices to Southern California residents to boost demand when they see slower reservations at the theme parks. And so they have some flexibility, and considering that they've nearly doubled prices since 2019, they can lower prices a bit in the theme parks to get people going, right? And once you get people into your theme park, people spend money while they're at the theme park. And so Disney can boost demand due to some of the levers they have. And then the streaming segment, now being profitable, will not weigh down on the company's results as it had been significantly up until now. Now, in the latest quarter, the company added 800,000 domestic Disney Plus subscribers, and they also added 100,000 subscribers internationally. I'm sorry, they lost 100,000 subscribers internationally. However, they have been raising prices meaningfully on their Disney Plus subscriptions, and they announced that they're raising prices again, roughly 10% for their streaming subscriptions, whether it be Disney Plus, whether it be Hulu, or whether it be ESPN Plus. They've been aggressively raising prices, and management said that when they raise prices, they don't see a meaningful amount of people canceling their subscriptions. So they noticed that they do have pricing power in the streaming segment, and they have been exercising that pricing power. As you saw in the most recent update, they are increasing prices again. And I've talked about this in the streaming industry, how I like this industry a lot because of that factor, because of all of the streaming service providers, mostly all of the streaming subscription companies have been raising prices. And that's good news for investors, because if everyone is raising prices, consumers don't have a place to go where they say, well, I'm angry with you for raising prices, I'm going to go with your competitor. But everyone is raising prices, so you can't go to somebody that's not raising prices. And what that means is higher profitability industry-wide, and that's good news for investors. And that's why I've liked the streaming industry overall. So now that we've looked at Disney's latest performance, let's look at the stock price. Disney is now trading at a forward price to earnings of just 15.89. This is about as cheap as you've been able to buy Disney stock going back several years. I feel this price to earnings ratio is a reasonable risk versus return. In fact, I think this is a attractive risk versus return for long-term investors. Disney stock had been rated as one of my top 25 stocks to buy and the top 10 dividend stock as well, because of the potential I saw for Disney to increase its dividend as the company increases its cash flow from operations, recovering from the devastations of the pandemic and the transition into streaming business. So following these results, I'm reiterating this recommendation. I still think Disney is an excellent stock to own for long-term investors at current valuations. Did you know that over 90% of the people that watch my channel are not subscribed? It'll really help support my channel if you hit that subscribe button. And oh, by the way, one of the benefits of being subscribed is that I take requests from subscribers more often than I do from non-subscribers. So if you prefer that benefit, please subscribe to the channel.